In the aftermath of the 2008 financial crisis, the world was bleeding. Trillions of dollars vanished from retirement accounts, millions of people lost their homes, and century-old institutions crumbled to dust. Yet, amidst the absolute devastation of the global economy, one bank not only survived, but walked away with billions in profit. They didn't just weather the storm, they helped engineer it, bet against it, and then got bailed out by the very taxpayers they had bet against. Rolling Stone famously described them as a great vampire squid wrapped around the face of humanity, relentlessly jamming its blood funnel into anything that smells like money. This is the story of Goldman Sachs. It is not just a tale of a Wall Street bank. It is the blueprint of how a single institution built an invisible empire, mastered the art of playing both sides of the board, and embedded itself so deeply into the highest levels of government that they don't just participate in the market. They are the market. To understand how they acquired this unprecedented level of control, you have to look back to a time before the algorithmic trading floors and glass skyscrapers. In 1869, Marcus Goldman, a German immigrant, started buying and selling promissory notes on the cobblestone streets of Lower Manhattan. It was a humble beginning, but it established the core philosophy of the firm, acting as the middleman. They were the bridge between people who needed money and people who had it. When Marcus's son-in-law, Samuel Sachs, joined the business, they expanded into a formidable partnership. But the true transformation from a respectable partnership into a global superpower began with a man named Sidney Weinberg. Weinberg started as a janitor assistant at the firm, making $3 a week, but he possessed a brilliant mind for networking. By the 1930s, he was running the place. Weinberg understood a fundamental truth that would define Goldman Sachs for the next century. Real power isn't just about having capital. It is about having relationships. He became known as the director's director, sitting on the boards of dozens of America's largest corporations. He practically invented the modern initial public offering, positioning Goldman Sachs as the ultimate gatekeeper for any company wanting to enter the public market. More importantly, Weinberg began the tradition of government entanglement. During World War II, he helped mobilize American industry for the war effort, building a revolving door between Goldman Sachs and Washington, D.C. that remains wide open today. For decades, Goldman operated under a strict code of prioritizing the client. Long-term greed over short-term profit was their mantra. If they made their clients rich, they would eventually get rich too. But as the 20th century progressed, the culture began to shift. Enter Gus Levy, the pioneer of block trading. Levy realized that acting merely as a polite middleman wasn't enough. There were massive profits to be made by taking risks with the firm's own money. This marked the beginning of proprietary trading. Goldman Sachs was no longer just advising corporations on mergers or helping them raise capital. They were actively trading the markets themselves. This shift created a massive, inherent conflict of interest. On one hand, they were trusted advisors to the world's biggest corporations. On the other hand, they were aggressive traders looking to exploit market inefficiencies. The line between serving the client and exploiting the client's information became increasingly blurred. By the 1990s, the trading floor had become the dominant profit engine of the firm. The partners were making millions, but the risks were multiplying exponentially. They had transformed from a traditional investment bank into a highly leveraged hedge fund with a banking license. This aggressive, profit-at-all-costs culture culminated in the housing market crash of 2008. This was the moment the vampire squid was exposed to the daylight. As the real estate bubble inflated, Goldman Sachs was busy packaging and selling billions of dollars in mortgage-backed securities to pension funds, municipalities, and institutional investors around the world. They told their clients these investments were safe. But behind closed doors, their own internal emails painted a very different picture. They knew the mortgages were toxic. They called them crap and junk. But they didn't just sell the junk to their clients. In a move of breathtaking cynicism, they went a step further. They secretly worked with a massive hedge fund manager named John Paulson to design a specific financial product called Abacus. Paulson handpicked the absolute worst mortgages he could find, the ones most likely to default, and Goldman packaged them into this Abacus deal. They then sold this engineered time bomb to their own clients, without disclosing that Paulson had designed it specifically to fail. Paulson bet heavily against it, and Goldman Sachs took a cut. When the housing market collapsed, the clients who trusted Goldman Sachs lost over $1 billion. Paulson made a fortune. And Goldman? They survived the very crash they helped accelerate, partly because the US government stepped in with massive bailouts to save the financial system. The penalty they paid for the Abacus fraud was a fraction of their quarterly profits. It was simply the cost of doing business. But the dark side of this global business doesn't stop at the borders of the United States. To truly understand their influence, you have to look at how they shape entire sovereign nations. In the early 2000s, the country of Greece desperately wanted to join the Eurozone, but their national debt was too high to meet the strict European Union requirements. Enter Goldman Sachs. For a massive fee, the bank engineered complex cross-currency swaps that essentially allowed Greece to hide billions of dollars of debt off its balance sheet. It was a financial illusion, a sleight of hand that made Greece's economy look much healthier than it actually was. The paperwork went through, Greece adopted the euro, and Goldman walked away with hundreds of millions in fees. But financial gravity cannot be defied forever. When the truth finally came out years later, the Greek economy imploded. The country was plunged into a catastrophic depression, unemployment skyrocketed, and citizens took to the streets in violent protests. The Greek people paid the ultimate price for the financial engineering, suffering through years of brutal austerity measures, while the bankers who orchestrated the illusion had long since collected their bonuses. It demonstrated a terrifying reality. An investment bank had the power to fundamentally alter the destiny of a sovereign nation and destabilize an entire continent, entirely hidden behind layers of complex financial jargon. If you think the regulatory slap on the wrist after 2008 changed their behavior, look no further than the 1MDB scandal. In one of the largest financial frauds in history, Goldman Sachs helped raise billions of dollars for a Malaysian state investment fund. The money was supposed to be used for economic development, to build power plants and infrastructure to help the Malaysian people. Instead, over $4 billion were siphoned off by a fugitive financier named Joe Low and corrupt officials. The stolen money was used to buy luxury yachts, fund Hollywood blockbuster movies, and purchase extravagant real estate worldwide. Goldman Sachs bankers facilitated these bond offerings, ignoring glaring red flags and massive conflicts of interest, all while collecting hundreds of millions of dollars in fees. It was a breathtaking failure of compliance and morality. The bank ultimately had to pay billions in global settlements, but the underlying system remains intact. The true power of Goldman Sachs doesn't lie just in the money they manage. It lies in the revolving door that never stops spinning. Their alumni populate the highest echelons of global power. They have produced U.S. Treasury secretaries, heads of the European Central Bank, and leaders of regulatory agencies worldwide. The people writing the rules for the global economy are often the very same people who spent their careers exploiting those rules on the trading floors of Goldman Sachs. They are the ultimate insiders, a shadow network of influence that dictates the flow of capital across the planet. You might never hold an account with them, you might never buy their stock, but make no mistake, through the companies they take public, the commodities they trade, the political campaigns they fund, and the economic policies their alumni write, they are shaping the world you live in. They are the architects of the modern financial framework, operating in the gray areas where legality and ethics collide. Every time you check your retirement fund or read about inflation, their invisible hand is at play. The global economy is not a chaotic accident. It is a highly engineered ecosystem managed by a select group of elites who have rigged the casino. The vampire squid continues to feed, adapting to every regulation and ensuring its survival. The house always wins.